So for education right now, when student wants to pursue higher education, he takes out a student loan. So we can consider that to be a sort of, say, bond that the student sort of issues.
Issues, yeah.
Yeah. So is it possible that, we could switch to an equity model where this...
Right, right. This is something I've been behind for a long time. But it's not new with me, the idea of having student loans that are responsive to income, so that protects you against the outcome that you might not get a great job even though you've incurred this expensive education. That goes back many decades. Even here at Yale in the 1970s, we created, I wasn't here then, but they created, with Professor Tobin, they created a income contingent student loan. And so now we have such things. President Obama is behind this too. But it's also happening in other countries. So student loans should be ideally contingent on the income of the borrower, as long as you can verify that. Now there's a moral hazard problem. We have to deal with that. We have to limit the... in fact, with the Yale experience, people were surprised when they made a lot of money and they saw their tuition debt go up. One thing that was a problem they hadn't thought of, what if you marry someone who makes a lot of money? Well, they didn't think about that, but the contract said it was the income on your tax form that goes into the formula. So the bad luck of marrying a rich person would cause Yale to get a lot of the pie. So these are problems, but they have to be worked out.
Do you think there's a student loan bubble forming?
Oh, now in the United States,
yes.
Maybe elsewhere too, but the kind of bubble I think that has been happening, I think it's partially driven by all this talk about robots and artificial intelligence and an anxiety that drives young people today. Where am I in this world? Every time I look around, there's some new thing replacing a job. So I think that there's an atmosphere of, I've got to be connected. I've got to be somehow the elite. The way we define elite, especially in America, that since there's no aristocracy, there's no lords or dukes or barons, you get status here by having an education. So people are willing to spend a lot for that. At the same time, after the financial crisis in 2008, governments are very wary of spending money. So the U.S. does have some support for college education, less so than in other countries, but they're pulling back on that, so that you kind of have to buy your own college education. Even the state universities are getting expensive because they're not being given enough money by the state governments. So it's getting expensive, and so people are borrowing to finance a quality higher education. But in some sense it's a bubble because it's getting expensive to go to college.
Yeah.
And also it might be a bubble in the sense that if a lot of people go to college, it might not be as lucrative as it used to be.
Yeah. You won't be able to pay it back.
Yeah.
And then you have to pay it back.
Yeah.
And you can't declare bankruptcy to get out of a student loan. That's a special law in the United. Did you? I hope you weren't thinking to do that. That's because it would be too easy. You would graduate and you'd say, "Hey, I don't have a job."
Interesting.
I remember for the MBA students, they offer an international loan for the international students.
Mhm.
I think they allow for the bankruptcy. Why?
I didn't know that. Please don't do it. Forwards and futures are kind of esoteric topic. Most people never deal in them. They're derivatives. They're so-called derivatives because they're buying or selling something on a forward or futures market is not as simple as buying on the spot market. So the spot market for anything is the market for immediate delivery. You pay the money, you get the item. forward and futures reflect contracts involving future delivery, and it's more complicated. But I think that they're really important to economics because our markets have to reflect time as well as quality. And time is an essential feature of our lives. And so we have, with forward and futures markets, we have not just one price, but a different price for every different future delivery date. So instead of a single number for something, or a commodity, say, it's a whole array of numbers reflecting the different delivery dates in the future. As I said, most people don't seem to know much about them, don't really think about what they are. I referred earlier to an essay that Charles Conant wrote in 1904 called Wall Street and the Country, the function of stock and the produce exchanges. And he was lamenting that the public just doesn't get it. They think that these markets are places where rich people gamble. They speculate. But in fact, well, there is such. People do gamble on these markets, but they do have a function, a real function. As he emphasized, they're tied to business. They're not games. Gambling is an entertainment industry. They conceive of games that will be fun to play. But it's not particularly fun to trade in pork bellies. Why would you want to do that? It's not a game. So it reflects some underlying economic activity. But I actually documented in a paper I wrote 25 years ago with Maxime Boyko how much people mistrust these markets. So we did a survey in 1990 in two cities, Moscow and New York, comparing attitudes to markets. And we asked about grain trading. We didn't mention forwards and futures because most people don't even have a clue that they exist. But they know there has to be grain traders. And of course, grain traders trade typically in futures or forward markets. So the question was, grain traders in capitalist countries sometimes hold grain without selling it, putting it in temporary storage in anticipation of higher prices later. Do you think this speculation will cause more frequent shortages of flour, bread, and other grain products? Or will it cause such shortages to become rarer? Well, the number one response was that shortages are more common. And in fact, the amazing thing is the Americans thought that. They're even more than the Russians. We thought that communist ideology would encourage the Russians to think that speculation creates shortages. But in fact, it was less than half of them who picked that. So what would you think about this? Does storing grain make shortages more common? I mean, I think just when you think about it in simple common sense, an oversimplified version of the world is there's one harvest of grain every year, okay? Does storing grain over the year make shortages less common? How could that possibly be true? Storing grain is essential if you only harvest it once a year. Somebody's got to store it, unless you could eat it all on the day of the harvest. But you can't do that. You've got to eat it over the year. So it's an essential business in every country, storing grain, okay? You understand that. When you buy a sandwich or have a breakfast bowl of cereal, you know that that cereal was in somebody's storage warehouse for, especially think about your, right now is a good time. We're in February, we're in March. It's just before a harvest. Right? We're coming out of the winter. And you better, everything you eat has been stored, unless it comes from South America or Southern Hemisphere. But the public doesn't get that.
What sort of products or assets have futures markets associated?
Good question. The people at the futures exchanges would like to know the answer. There's an old story, a futures market story, that You know how they figure out what markets will be a success? It's the same rule that chefs use. They call it the spaghetti rule. How do you know when spaghetti is done? You take it out of the pot and you throw it against the wall, and if it sticks, it's done. Okay, it's the same thing. You start a futures market. It sounds plausible, and you try it, and if it goes, it goes. If it doesn't, you shut it down. So I've had experience with starting a futures market. With my real estate, my colleague Carl Case and I worked with the Chicago Mercantile Exchange and created home price futures market. It's now 10 years old. It's going, but I have to say it wasn't as big a success as we'd like, and we just don't have a clear answer. Real estate is a huge market that occupies a lot of attention. People worry about the values of their houses. They are looking for answers. So you'd think they would trade a lot in a futures market. I think that they may yet do that, but as of this date, it hasn't been big. Now, one thing, your question is a little bit like asking, how do you know when someone will have a nice party at his house where everybody comes? Well, when you throw a party, you never know that it'll be a nice party. And if everyone hears there's a great party at so-and-so's house, they all come. It's that sort of thing. It's a social phenomenon. Some efforts to start futures markets have attracted a huge attention, and others haven't. It must have something to do with risk and the feeling that there's a lot of risk to be managed. And so maybe the problem with single-family home futures is that the homeowners are not professional risk managers, and they're there for a long time and they can forget about the risk of their home. Maybe that partially explains it. But I don't know that we have any really solid explanation for why some markets exist and why some don't. A forward contract is a contract between two individuals, you might call them counterparties, to deliver at a future date, called the exercise date or maturity date. Historically, forward contracts preceded futures contracts. A futures contract is a more sophisticated idea. So, for example, what was happening in Dojima before the 1670s, rice farmers would make a deal to sell their rice to a warehouser. Now, they could just wait until the harvest is in and then bring it to Dojima and see what price they could get. But they have an alternative of establishing the price earlier and locking it in. And farmers like to do this because they don't know what the price will be when they sell it. So you put in a lot of expense to produce the product, and it might not pay you back all of your expenses, so you don't like that. So they typically like to lock in the price. That's called, if you do it directly, and typically you would sell it to a warehouse or a grain elevator, as they're called. There would be a local grain, I don't know about rice, wheat, or corn, or any of these. In the countryside, there's a local grain elevator. And you can go to that person and say, I'm planning to harvest rice at such and such a month. Will you buy it, and can you give me a price today? Most farmers don't hedge in the futures market. It's too complicated and sophisticated. But the grain elevator or the warehouser, I think they almost always hedge because they're going to be storing. The storage business is a tight margin business. It's very competitive. You could store a lot of grain and then not, or promise to buy grain at a price that turns out to be unprofitable for you. So what happens is the storers of grain are the hedgers, and they will quote prices to farmers as a forward price. There's other kinds of, it's not just grain. Grains are historically the origin of forwards and futures. But let's talk about other things. You can also make a forward contract to exchange pounds for yen, or dollars per yen, or any number of combinations. So if I make a forward contract, both sides are locked into the contract, so they have no liquidity. Why do they do it? Well, they do it because they don't want to fit into one of those standard contracts that are offered at the exchange. They might want a different delivery location. They might want a different date. They might want a different quality. And so they make forward contracts are big. But the problem with forward contracts is you can't get out of them. And you don't necessarily trust the counterparty. What if the farmer just he gets drunk, it doesn't plant, and you're standing on the other side of the contract, so you're out of luck. The advantage of futures contracts is that you don't have to worry because your counterparty is the futures exchange. It's not between the producer of wheat and the manufacturer of breakfast cereals. The producer of wheat deals with the futures exchange, and so does the manufacturer of breakfast cereals, who might be taking effectively the other side. So they have to, if you're going to go with forwards, you have to worry about your counterparty, and you have to check the counterparty out, and you need to establish that the counterparty has good credit, so they're inherently limited. Futures markets, you want to trade, you can call up a broker tomorrow and trade. The broker will do it with anyone who posts margin. But let me come back to that. Forward exchange futures, a forward exchange contract, FX forwards, can be thought of as a pair of zero coupon bonds stapled together in two different currencies. Suppose I'm selling goods. I'm a Japanese producer of goods which I'm selling in the United States. I'm going to sell them for dollars, of course. Americans pay dollars. And then I want to repatriate the money to Japan, so I'm going to exchange it into yen. But I want to have a forward contract which locks in the price today. I don't have to go through the forward market. I can borrow the money today in dollars, exchange it at the spot exchange rate today into yen, take the yen back to Japan, and put them in some interest-bearing account in Japan, earning the Japanese interest rate. So I'm going to be charged the dollar interest rate, but I'm going to be credited the Japanese interest rate. And so I'll have an amount left at the end equal to the product of the spot exchange rate times 1 plus r yen divided by 1 plus r dollars. So that's what I could do without entering the forward exchange market, just by trading currency, by borrowing and then investing in Japan. So this number should equal the forward exchange rate by arbitrage, because it's two different ways of doing the same thing. And so they should be the same number. So that means that the forward exchange rate, yen-dollar exchange rate, is not as interesting a number as you might think. You might think that the forward exchange rate is some prediction of the spot exchange rate. Well, maybe it is, but it's also just this. It reflects the relative interest rates in the two countries. If you look at forward exchange rates and compare them with spot exchange rates and check out this formula, it works pretty well explaining the forward interest rate. So that's called forward interest parity. Forward rate agreements use a formula which looks a little, it's not exactly what I just showed you. They typically actually just have a settlement, which is the actual interest rate on the contract date minus the contract rate times the days in the contract period times the contract amount divided by B, which is, depending on the convention, either 360 or 365 days. We're in leap year this year, so we have 366 days, so that you know the formula won't be exact, because it's either, they went back to 360 days for formulas like this because people couldn't divide. It was hard. They wanted a round number, so that's an old tradition. And 366 doesn't appeal to anybody, but that's the settlement formula. A futures contract is like a forward contract, except there's an intermediary, the exchange, who you make your contract with the intermediary, not with the ultimate counterparty, and they're standardized. If you drive through the country where they grow grains, you will see silos or warehouses here and there dotting the landscape. So grain elevators are important. If you turn on the radio and you listen to a local radio station, you will hear them quoting the futures markets, because farmers locally are very interested in those futures prices. Some of them aren't protecting themselves, and so it's really big for them. Now, you don't hear spot prices very much. Or maybe you can go tell me otherwise, but I think when I've been driving through the country, I've been listening, because spot prices don't mean anything. They're just a noise, because you just never know who traded that and what the situation was. But futures contracts are the things that farmers listen to all the time. Now, futures contracts rely on margin calls.
When an investor uses margin to buy or sell securities, they are paid for using a combination of his or her own funds as well as money borrowed from a broker. The investor receives a margin call from a broker if the securities in the portfolio decrease in value past a certain point, after which the investor must either deposit more money into the account or sell some of the assets.
So I mentioned, with a forward contract, you're worried that the other guy might be a drunk or might be irresponsible or might not plant the crop, who knows? How do futures contracts deal with that? Well, futures contracts, when you sign a contract, it's an active, living thing. The contract requires you to pay a settlement every day from your futures margin account based on the change in the futures market on that day. So the broker will have you sign a contract, and now you might not be a very reliable person. You might be a person who sometimes goes for weeks without answering the phone, all right? They've taken care of that in the contract. The contract says, if you don't do anything, if we call you up and say, your margin account is falling low because the futures price is moving against you, and you don't answer the phone, we will close you out, and your margin account will be maybe close to zero. We won't let it hit zero because they don't trust you, because they don't know who you are. They don't care who you are. They only look at the margin account. So you're supposed to allow them to deduct. They won't call you every day. If you are buying the futures and the price is going down, it's moving against you. You bought the futures because you were worried that the price would go up, right? And you wanted to lock in a price. If the price goes down, then it's moving against you. And so they will remove that amount from your margins account. You can get out at any time, but if you bought futures and price has gone down, the reality is you have to get out at the new price. So they've already taken the money from you. That was the deal, from your margin account. And you don't have to answer the phone. You don't have to do anything. And it's no crime if you run out, if your margin account is deleted. Of course, you won't be hedged against price risk anymore. But you got to answer the phone. That's why most farmers don't trade in futures. It's just too nerve-wracking. Margin calls are very unpleasant. The guy tells you, well, you put $10,000 in your margin account. I'm sorry to say, it's down to $1,000. So they have what's called initial margin, is what they require you to put up. And they have something called a maintenance margin, which is when they make the phone call to you saying, your account has gone against you. You either put up more margin or we will close you out, which means buy a offsetting, or if you bought, they would sell on your behalf. And then you're out of the market. The world's first futures markets came in the city of Osaka, Japan. In fact, a part of Osaka called Dojima. In the 1670s, this was during the Tokugawa period in Japanese history, when Japan was isolated from the rest of the world, except for the Dutch. For some reason, the Dutch had special dispensation to come in and do business in Japan, but everyone else didn't. Funny thing that this futures market idea originated in Japan, but I think it had something to do with the Dutch, because the Dutch had just invented, in the beginning of the 1600s, the first real stock market, and they were doing options trading and short selling. They were the most advanced financial country in the world in the 1600s. So maybe some of it kind of spilled over into Japan, but the Dutch didn't get this. They didn't get the idea of a futures market. So now Dojima was the storage center for rice in Japan. They had a lot of warehouses. I was recently in Osaka, and I asked, actually I'm going to be in Osaka next week again. Maybe I'll ask again. I said, where can I see some remains of the futures market? And they said, well, that's all long gone, nothing left, so nothing to see. But it was big. There were, how many? There were 91 rice warehouses, according to one historian's count, in Dojima in 1673. Well, it was a substantial part of Japanese diet, and somebody had to be storing it. It was a serious business. So they also had, so people in Japan who dealt in rice or rice products would go to Dojima to buy the rice. And what they ended up doing is making contracts for future delivery. So there were a thing called rice bills, which were, rice was a little bit like money. You could borrow rice and pay it back at a future date. So you could buy your rice at a future date. I'm anticipating my forward contract story. But the futures exchange is something a little bit more sophisticated. It was a center for information and hedging about rice, rather than focusing on delivery of your rice when you want it. So what it did is it had a specific list of delivery dates for rice at Dojima, so that you could sell rice in the future for delivery to a warehouse in Dojima, or you could buy it, but at a future date. That means they can't look at the rice now, so they have to specify what kind of rice it will be. So the Dojima Futures Exchange had precise definitions of quality, delivery date, and place. And they had experts at the warehouse whose job was to evaluate quality of rice. And so you would be signing a contract for delivery, but you didn't necessarily have to fulfill the contract because it was a standard contract and you could always buy your way out of it. So if you were a rice farmer and you had promised to deliver rice to Dojima as of a certain date, and now you thought, well, maybe I won't plant as much rice, so I don't really want to deliver. I won't have enough. I've changed my mind. You could go back and just sell that many contracts so that you've reduced your exposure. It creates liquidity in the rice trade. Since then, actually, rice futures became big in Japan from the 1670s until World War II. And it somehow got lost in Japan after the war because there were a lot of things happening. And it got set up elsewhere in the United States. And then anyone in Japan who wanted to hedge rice futures could have to do it in Chicago. Chicago became the world center for a lot of future. So we have rice futures, but now don't deliver them to Dojima. If you go there, I think what I got, my impression, it looks like downtown Osaka to me. I'll have to look again, but there's no place for you to deliver it in Dojima. You have to deliver it in Chicago, okay? And so here is the standard contract. It says Chicago Board of Trade, CBOT. Historically, that's what, although CBOT merged with the Chicago Mercantile Exchange in 2007, and they now call themselves the CME Group. But we'll still call it a CBOT contract. So now it's different from a contract that you might sign if you wanted to buy rice, right? If you are a maker of Rice Krispies or whatever, you might want some other amount than this or delivered somewhere else, but that wouldn't be a standard contract. This is the standard contract. which is the liquid contract. So the contract, one contract is for 2,000 hundredweights. What is a hundredweight? That's just 100 pounds, avoirdupois. But you can't buy less or more than that. That's the size of one contract. And here's what it is. It defines that U.S. number 2 or better long grain rough rice with a total milling yield of not less than 65%, including head rice of not less than 48%. And it goes on and on. That's what you have to deliver. It's priced in cents per hundredweight. The tick size is it's an exchange. It only allows you to change the price by a certain amount. Now, why would be people interested in doing a standard contract rather than a contract? I don't want 2,000. I want 2,500 hundredweights or something like that. But see, this is the genius of the futures market. It creates a meaningful price, and it creates clarity for the future. So there's lots of prices for rice, lots of spot prices for rice. You can go to some place where they're selling rice spot, but if you go there, they'll say, well, the rice that we got today doesn't look good. I haven't studied it, but I think it's not deliverable for the CBOT. Nobody's watching. Well, if the buyer is watching. The buyer looks at it and says, okay, I'll pay this for this. But it might be bad rice, and there's no official statement. You find a hundredweight that's sold for some price. You don't know why. Maybe there was something. Maybe the guy threw in a toaster oven or something as a gift. So if you really want to know what is the price of rice, you can't know what the price of rice here is. You can only know what the price of rice in Chicago is, because there's a futures market. And look how precise they are. So they have these delivery standards. Now, I'll tell you one thing. Nobody delivers better rice than the Standard. I went to the Coffee, Sugar, and Cocoa Exchange once in New York. I had a tour. And I said, can I sample some of your coffee? Here I am at the world's headquarters for the coffee trade. And he says, well, I wouldn't recommend. Let's go to a Starbucks across the street. Our coffee isn't great. It's very ordinary coffee. But of course it's ordinary coffee because they want it to be liquid. They want it to be the big market. So if you are buying, so here's the idea. If you are buying, expecting to buy good coffee, let's say, next year, you can sort of lock in the price by buying the ordinary stuff on the futures exchange. And then any price fluctuation, which will probably be shared by both types of coffee, will affect your futures contract. And you can sell out your futures contract just before you would have bought the good stuff. And you've protected yourself against price fluctuations because the two probably move together. So most futures contracts are closed out without delivery. Most people, it's simply like this. Suppose you are a rice farmer in the United States or in Japan, and you're worried about the price you can get for your rice when it is harvested. You will sell your rice in Chicago, knowing full well I'm not going to ship it to Chicago, but I just believe that its price in Chicago will move with the price wherever I am. And it's just an insurance against price drops. If I'm a farmer, I'm worried that I won't get enough money for my crop and I won't make it. So this is a really important concept that is not obvious, that futures markets are rarely delivered. The only time they're delivered is when the sharp operators called arbitrageurs decide that there is a difference between the futures price and the spot price in Chicago, or enough of a difference. So I once had to deliver, or to take delivery on the other side. Now, I once had a tour of the CBOT, and we met I don't know what it was, some kind of grain trader. And we had a chance to interview him because we were guests of the exchange. And I was impressed. This guy had a memory. We had a plot of futures prices, and the price was spiked up once in Chicago. And I said, look at that spike. Why did that happen? And he said, oh, I remember that perfectly well. There was a shortage in Chicago, but there was a rail strike or something, and the grain was waiting in Iowa, and we couldn't get it. We were really trying to arbitrage that spike because the spike was only in Chicago, but we couldn't get it to Chicago. So I went out and I rented trucks, but it was expensive. I couldn't get that many trucks. So they live this story. Normally, the arbitrageurs pay little attention to futures prices and relative to spot prices, unless when it's getting close to the delivery date, they diverge. Then they look, should I have an opportunity taking delivery? And I'll bring my trucks to the warehouse in Chicago. I'll load up the rice and I'll bring it to Iowa and sell it where the price is higher. Or the reverse, I'll deliver. And there's a small group of very sophisticated rice traders who do that. And the rest of the world hedges. So in Japan, a farmer in Japan could hedge in the Chicago rice market. And has absolutely no thought of delivering to Chicago, wouldn't know how to do that. So here is the rice futures curve as of yesterday at the CBOT, CME group. It's going for the nearest contract, I think, is May. It's going for a little over $10 per hundredweight, or 10 cents per pound. So if you go to the store and look at what does a pound of rice cost when you buy it in the grocery store here, it must be something like $1, right? You can't get it for 10 cents because you can only get this price if you buy, what was it, the 2,000 hundredweights? What did I say?
91 metric tons.
Yeah, 91 metric tons. That's a lot of rice. You want it delivered to your store in a nice little package with colorful graphics on it. Now, the other thing, you note that it goes up with time. And that's a fundamental thing. Most of the time, futures prices. Now, you understand, this is all as of March 8th, 2016. This is for delivery in May of 2016. And at the other end, it's delivery in maybe May of 2017. So it goes up with time. This is a price that I can lock in today, if it's March 8th, 2016, for May 2017. And this upward sloping nature of the futures curve has been called contango. I need to know the etymology of it, but contango is normal in futures markets. If you want delivery at a future date, it's going to cost you more. Not always, though. It can sometimes be in backwardation, which is where it falls into the future. But that's, well, I'll give you an example sort of that, but it's anomalous.
Well, there seems to be a widespread distrust, though, of the futures market, and much of the blame falls on the speculators and the algorithmic trading systems that creates this volatility. Do you think this is justified, and is it unfair to the hedgers to actually have these speculators in their trading?
Well, I think there's nothing wrong with being a speculator because they're the ones who really think about where things are going. They're not the same as, okay, someone who is managing an oil facility and storing oil comes in as a hedger. I'm looking at this oil that I've got there, and I'm worried I'm going to sell it in another month, but what's the price going to do in between? That's a hedger. The speculator has a different mentality. The speculator may be thinking about international politics and thinking about technology changing and thinking that, this oil price isn't going to hold. That's because the speculator has an intellectual curiosity about markets and is thinking broadly on a broad plane. And he may actually have wisdom to see that there's something wrong with the price. You want that guy in there to allow that expression, that opinion to be expressed in the market. So I think there's nothing wrong with being a speculator. I think it's a noble profession. So why are there prejudice against them? It goes, I think it's largely because most people have not had an economics course, and they have not read Adam Smith, his 1776 book, The Wealth of Nations, that talked about prices as allocators of scarce resources. They haven't thought about that. They haven't thought about how one could reduce risks through trades. That's hedging. What do they do? The most natural comparison for the typical person is with gambling, because they do that. Surveys have shown that most people gamble, at least a little. You've gone to the casino, right? I don't know if you want to admit that here. So that's their personal experience. So it looks a lot like gambling. But you have to make a clear distinction between speculation and gambling. Gambling is an entertainment industry. They are trying to get people looking for fun, and they're putting them in an environment that they enjoy. Speculators, they may have a gambling impulse, but on top of that, the speculators that I think of as important are those who think as intellectuals about the big picture drivers of prices. And they may think that this price is wrong today. I can't prove it, but I strongly suspect it's wrong, and I'm just going to take a position against it. Even though I'm not hedging, because I don't have any reason. I'm not storing something. I'm not running a business that's vulnerable. I'm just in it because I'm interested in where the market is going. Now, some people doubt that speculators do anything good, but I think that they must. Because if there weren't speculators, I think the markets would be even crazier than they are, because there would be nothing tying them down accurately. Now this is wheat futures. This is number 2 soft red winter wheat, or number 1 soft red winter. I don't know what number 1. It's a different grade of quality at a 3-cent premium, and the pricing is in cents per bushel. The tick size is 1/8 cents per bushel, and you're buying 1,000 bushels. That's $1.25 per contract. Is that all understood? So when we have both winter wheat and summer wheat. Soft red you don't know these things because you're not a farmer. Maybe you know if you're a good cook. Soft red winter wheat, they make it into flour, and it's called cake flour. It's good for cakes and biscuits and cookies, and also breakfast cereals like to use soft red winter wheat. Not so good for bread and other baked goods. They also sell something called all-purpose flour, which I believe is a mix of different kinds of wheat. But why do they call it winter wheat? That's because you plant it in the fall, and it lies dormant over the winter, and it's harvested typically in May, depending on your climate. So it's a springtime crop. So I don't know if you cared to know about all these wheat facts, but I looked up the futures curve for soft red winter wheat for March 8th, 2016. And it shows this contango again, but not everywhere. Now actually, in other years, it's shown more of a variation. But there's a tendency for a lot of commodities that have a crop once a year in a fairly well-defined time for the futures price to go into backwardation at the time of the crop. And you can see it. It's roughly May. So in May of 2016, it's not going into backwardation at all. May of 2017, it's slowing down a little bit. I think the prices are kind of low. A lot of commodities prices are low at this time in the new normal. But you can see it's going down quite a bit in May of 2018. But all that reflects is that they've just had a harvest. The harvest is coming in then. They're going to dump it on the spot market, and the price is going to fall. Just before the harvest, a lot of people are running out. The warehouses are empty. There might even be a surprise. They might have gotten emptied out faster than we thought, and there could be a shortage That would be reflected in futures prices. The futures market makes the shortages less severe because you can see it coming in the futures curve. So if there were a big drop in May of each year, then you'd think, uh-oh, there's going to be a shortage. At least the market is predicting that. I better think about it, and I better hold off selling some of my wheat now because I don't want that short. So it provides what you call price discovery. So it doesn't look like there's much fear of a shortage of wheat before the next harvest. We're right now just before the harvest, and I've been watching the squirrels in my yard, and I feel some sympathy for them because they're tearing up my whole lawn looking for the last acorn that they buried. They're like, it's really a basic business. Squirrels are in the same business, storing acorns over the winter. And depending on the acorn crop last year, the squirrels are either in an okay shape or they're starving, right? This is the tough time of the year to be a squirrel. So I don't know, if you look at lawns, they're really tearing up the lawns. And I think that's because maybe it's a bad year for squirrels. So the futures price for acorns in the squirrel land is really high right now. They need a futures market, but they're not smart enough to invent something like that. So again, when someone buys a futures contract, one agrees with the exchange to a daily settlement procedure. Now on the floor of the exchange, they traditionally used hand signals because, and this goes back to dojima. It shows that dojima is really the source of the whole idea of futures trading. So you get all these people together in a so-called pit where traders talk to each other, but there's so much noise that you can't hear someone standing right next to you. They're all shouting. So they developed a sign language. So if you want to buy futures, you'd put up your hand like this, meaning buy. And then you had ways of signaling the number, the price. And if you sell, I guess you have your hand out, meaning I want to sell. The dojima contract also had some funny features. They wanted to impose a trading hours in Japan back then, a long time ago. And so they didn't have clocks, so you couldn't put up a nice clock on the wall in those times. So they had a burning fuse. And just before the closing of trading, they would light the fuse and everyone would see the fire. And when the fire went out, that was a warning, like a 5-minute warning. The market will be closed as of that time. And they wanted to stop trading after the market closed. And so they had what were called watermen who came with buckets of water, and they walked around the trading floor and they looked for someone who was still trading, and they splashed them with water to stop trading. We don't do that anymore. In fact, now it's all largely electronic. There still are. If you can still go to the CME in Chicago and see people on the floor trading with their hand signals, but it's last time I heard, I was there on the floor a few years ago. It looked awfully quiet. It's dying down because so much more is electronic. So I mentioned before, there's daily settlement. Every day until expiration, a margin account is credited or debited with an amount equal to the change in the settle price times the contract amount. Oh, by the way, the settle price, you might think of that as the last trade of yesterday. But the problem is that they're worried about people trying to manipulate the last trade of yesterday because it could be a small trade and then there would be big settlements based on the trade. So in order to protect that, they have a settlement committee that looks at the final trades and asks whether they're representative. And they might choose a settle price which is not the same as the closing price, the last price. All right, so but the only difference is the last day. So if it's a physically settled commodity, physical delivery futures market, the last day is different. The last day, if you haven't closed out by the last day, if you're a seller, you'd better be there with your trucks of grains. And if you're a buyer, you'd better be there with empty trucks to load it in. But the only people who do that, everyone else is closed out before the last day. The only people who do that are arbitrageurs. So a farmer in Iowa who's planting a crop expected to yield 50,000 bushels is essentially long 50,000 bushels and so sells, let's say, 10 Chicago September corn contracts for the price on that date and post margin. A corn produced products manufacturer plans to buy corn at that time and buys the 10 contracts. But again, they never talk to each other or meet each other or worry about each other because they're both doing this with the exchange. So they locked in the price for both of them.
I'm really curious about the role of arbitrage in the futures markets. Someone could, for example, take possession of rice or iron ore, but then if the pricing's too low, sell it at the spot price. However, if the underlying commodity is actually an index rather than a tangibly traded future, what is the role for arbitrage in creating sort of that layer of efficiency?
Okay, good question. So let me get back to the core idea of a futures market. Let's start with, as you described, physical delivery. So let's talk about a corn futures market. We have that at the Chicago CME Group. One contract is 5,000 bushels. You can buy corn for a year in the future. What does it mean to buy corn a year in the future? What it means is I put up margin today. So 5,000 bushels might cost something like $50,000 depending on the price. So if I agreed to buy 5,000 bushels in 1 year at $10 a bushel, do I have to put up $50,000 today? No. You only have to put up margin today. And then then your margin account is credited or depleted as the price changes. And at the final, there's a final settlement at the end where you either have to deliver the corn and take at the then futures price. What tends to bring the futures price in line with the corn price in the future is, as you say, the fact that if the futures price differed a lot from the price of corn, if the futures price were, let's say, below the spot price of corn on that date, then people would be buying the futures and bringing the corn for delivery and selling it, which they tend to make the two convert. That's what you understand already. But the other side is, what if the contract is cash settled? Then you have the same daily resettlement. So if I buy S&P 500 index futures for delivery in 1 year, what it means is the price today, if it never changed, would lead me to a settlement at the end. There's two S&P 500 index futures. There's one, the regular conventional one, which is $250 times index, and there's the E-mini, which is $50 times the index. Now there's nothing you can deliver. You can't deliver the S&P 500 index. It's just a number. But it's the same thing, that you have to put up margin at the beginning, and then the daily resettlement of your based on changes in the futures market will raise or lower your margin account. But when you come to the end, there's a final settlement. Now this is maybe what is a little bit tricky to understand. The final settlement does not involve you coming with 5,000 bushels of corn and arriving at the facility that receives corn, or empty trucks to receive 5,000 bushels of corn. There's no such thing. But on the last day, there's a final settlement, which is the difference between the last futures price and the actual index. So it's as if you had, it represents the profit or loss you would have made if you actually delivered the index. So that means that if the futures price is below the S&P 500 index on the day before the final settlement, you can be an arbitrageur just the same. You don't have, all you have to do is buy a contract, and that's all you need to do, because it'll automatically settle at the end as the difference between the index and the futures price. So it's even easier to arbitrage the financial futures contract. So it happens quite reliably. That is, what's quite reliable is on the last day, when the delivery day, that corn price future is going to be exactly the same as the price of a bushel of corn, and the S&P 500 index future is going to be within a tiny margin of error, the same as the S&P 500 index. So it's a clever system. I hope I made that clear. But cash settlement opens up the possibility of doing many more kinds of index. I was mentioning my home price future. That's a cash settled contract. We can't deliver homes. That would be kind of tough. How would you deliver a home? And also, homes are not standardized. They're all different. When you have a physical delivery as a settlement procedure, it has to be possible to define precisely what it is that's delivered. But homes are so variable, and some of them are beat up and run down, and some of them are beset by crime, and some of them are wonderful neighborhoods. I mean, it's all so intangible. So you need cash-settled futures. It's kind of remarkable that cash-settled futures didn't really occur until a few decades ago, because it's a great idea. It's one of those inventions in finance that I like to talk about. Now, here's an important concept: fair value in futures contract. It's a little bit like the forward interest parity that we talked about in forward rates. What should the futures price be? Well, let's consider a physical delivery futures contract where the grain is in storage, and there's a percent storage cost, S, per unit of time, let's say per year. So S is the percent of the value of the commodity that it would cost you to store it for 1 year. That's something that is quoted to you by a warehouse. The warehouse will tell you, I'll store it for you for 1 year by such and such an amount in dollars. You divide that by the value of it today, and that's the storage cost as a percent. R is the interest rate for the same interval of time. So we're talking now about a futures contract, let's say 1 year ahead, or it could be any other year ahead, times ahead, but we have to adjust. If it's 1 month ahead, then we want the 1 month interest rate and the 1 month storage cost. The fair value equation, the famous equation, says the price of the future is equal to the price of the spot times 1 plus R plus S, which says that normally, because R and S are normally positive, futures contracts are generally in contango. They're generally upward sloping, because the longer in the future that the contract is dated, the higher R is. Remember, this is R per month if it's 1 month in the future. It's R per year if it's 1 year in the future, which would be 12 times bigger. So you can see that it makes for an upward sloping futures contract normally, except at harvest time, maybe. At harvest time, you could say this doesn't apply anymore. You can put it in different way. One way is saying it doesn't apply anymore because nobody's storing anymore. But then, of course, somebody is storing. I mean, you've got it stored somewhere. But maybe it's gotten kind of rare. Another thought, some people say that we can end up in backwardation if the storage cost becomes negative. Now, that's a way of thinking of how can the storage cost be negative? Well, it can be. Here's how it can happen. Go to a manufacturer of breakfast cereals. This guy feels it's very important that we ship so many cartons of breakfast cereal every month. And there's uncertainty about shipments and deliveries. So the guy there wants to keep a store of grain, let's say wheat, in the factory warehouse. Because suppose you're a maker of Wheaties and you suddenly run out of wheat, then your employees all show up one morning to make Wheaties and there's no wheat. So you have to pay them for the day's work and they didn't do anything. So you're losing money. So you want to have wheat in storage at all times. So suppose wheat is getting really scarce. It's the end of the season and the harvest is not in yet, so you can't buy it from the farmers. You might actually quote a negative storage cost to someone who wants to store wheat, right? You'd say, look, I don't want to risk my factory shutting down, so I'll just charge you minus 2% if you'll let me store the wheat. So that's, in effect, what happens in backwardation. Or another way of saying it is that if the commodity is not in storage, then it is possible that the future, if you want to count this as a normal storage cost, the price of the future can be less than fair value. So that's sometimes happened. Now I wanted to talk about oil futures because that's especially interesting right now with the volatile oil prices. So there's Chicago Mercantile Exchange bought the New York Mercantile. CME is gobbling up other exchanges left and right. They bought NYMEX, the New York Mercantile Exchange, which was the principal oil futures market. And so now it's also CME. But their big contract is crude light sweet oil. I don't know why they call it sweet. I wouldn't taste it. But the contract size is 1,000 barrels. There's a lot of these. Open interest is the total number of contracts that are outstanding as of any time. So that's an outdated number, 431,000. And it trades by physical delivery. There's also a Brent crude contract at the International Petroleum Exchange in London, etc. Here's the futures curve as of March 2016. It's in contango, normal. It's upward sloping. So when you hear oil prices quoted, you'll probably hear the nearest futures market. And that's the close, I think it's April. And then it just keeps going up. So we have relatively low oil prices now, but the market thinks that they're going to go up. But it's also maybe just fair value because people who are storing, this is, how much is it going up? Because somebody's storing oil, they wouldn't see, it's a mixture of whether this is really an expectation of future oil prices or it's just interest rates and storage costs. It's also an expectation of increases in prices, but it equilibrates to equal fair value. Now the interesting thing about oil that most people don't probably realize is that most of the inventory of oil is moving through the metaphoric pipeline. I don't mean necessarily literally an oil pipeline, but most of the oil is in the ground. We don't have storage for most of the oil. It's not above the ground. There's no point in pumping it out of the ground and then paying for an expensive storage facility. So it's mostly in the ground, and what's out of the ground is moving through the pipeline. And it's going all different places. Most of the, do I have a slide on this? Most of the oil that is sold in long-term contracts. Most of the buyers of oil, we're talking about crude oil, are refiners who have a regular process. They want to have it regularly delivered every month or however often. And they have a special contract, which is long-term. So there is no spot oil price there's no obvious spot oil price. Now there are spot oil prices, but its overwhelming majority of oil is not sold on the spot market. And the spot oil price is a volatile number. It differs from place to place. So again, when you look at oil price, typically when they quote that, they're quoting the nearest future contract. So it's slightly in the future. So this is a plot of oil prices from global financial data. Well, the oil prices are back to 1871. And I've converted them to real terms. That's the dashed line. The thing I'm emphasizing is the oil price, but it's kind of outclassed by the stock price, which I put on with it. So this is an interesting chart because what it shows is that for the last 100 years, in real terms, oil has not gone up in price. In fact, it's quite a bit lower right now a lot lower than its 1871 price. In contrast, the stock market has had quite an upward trajectory over the century. Now, most people think that we're running out of oil. Well, we are obviously running out of oil because we only have so much in the ground, and we won't have it. We won't have it in the future once we use it up. So there's always been talk of running out of oil. So there should be an uptrend, but there is no uptrend at all. I think that's because they're discovering alternative energy sources. They're discovering more oil all the time, new ways of extracting oil that was unextractable in the past. And we always keep surprising ourselves with the abundance of oil. And whether it will ever go up, for sure, is not really known, because we're getting solar power developed more, nuclear power may be developed in a better way, and it may just fizzle the whole thing. Nobody knows. But let me go back to some of the history. In 1891, the Texas Railroad Commission was established to regulate railroad rates. But in 1917, the U.S. pipeline petroleum law put pipelines of oil as common carriers under the control of the Commission. So they effectively controlled and stabilized oil prices from 1917 until 1970. And you can see that on this chart, more or less. Well, that's 1917, and that's 1973. Especially right in this period, from after World War II until 1972 or 3, it was absolutely constant. They just didn't allow oil prices to change. We had a government control of oil prices. But then, this was the first oil crisis. You can see there was a huge spike up. This is what actually happened was the U.S. ran out of oil. The U.S. was the first country to be a big oil refiner. We drilled oil wells all over the place. We discovered oil in many places in the U.S., and we just went through it and exhausted it. Then we had to rely on foreign oil. We were starting to rely on it around here, and then we hit the first oil crisis. So, there are other things happened. Governments around the world started nationalizing oil. Mexico was the first in 1938, Iran in 1951. It began to be a military thing. Ownership of oil was not like other things. The government would grab it. The word nationalization became popular in the 19th century. Because oil was considered our national heritage, how did these oil companies get control of our oil? Let's just take it back. And they got away with it. Organization of Petroleum Exporting Countries was established in 1960 by these countries. And then they kept adding members. And the purpose of OPEC was fixing prices. They wanted to keep them up. And they didn't want their other people, these countries dominant. The U.S. is not a member of OPEC. We didn't have any more oil, so we couldn't be a member. We didn't count. But these other countries, we had some oil, but not a big producer. These other countries would get together and agree to limit their production of oil to keep the price up. Now, there's a fundamental problem with the world oil market, and the problem is the property rights are not clear. Most people thought over all this time that oil prices were going to head higher, but they didn't, but they thought they would. So you'd think they would hold oil off the market, but they never did, not as a world. And that's because I think they didn't feel confident in their ownership of oil. Typically, oil is controlled by some government, non-democratic government, tenuous hold on power. They feel threatened. There's terrorists attacking them. They want people to be happy. So they just pump oil at a really high rate. And they don't care about the future, because I might not be dictator in the future. And so they didn't limit their... OPEC was trying to get them to limit their production of oil, to keep prices up, but they've had various problems, and they're particularly weak today because of conflict in the Middle East. In the first oil crisis, it was due to Arab countries' retaliation for U.S. support of Israel in the Yom Kippur War. They cut back. They managed to because ideologically they weren't very good at rigging prices, but when they get mad and embarrassed by a war that they lost, they wanted to do something, and they could cut. They did succeed in causing an oil crisis, which caused a worldwide recession. It was also the biggest drop in the U.S. stock market, the biggest two-year drop since the Great Depression. The second oil crisis, again, was caused by a political situation, the Iranian Revolution, which led to war in the Persian Gulf and disrupted oil supplies. And it caused the greatest recession ever, after the Great Depression. They called it the Great Recession, but we've retaken that word and use it to refer to the 2007-2009 recession. But it was the worst recession since the Depression of the 1890s. The political situation in OPEC deteriorated, and the OPEC cartel got weak after the 1980s, which allowed oil prices to fall. The United States has a bunch of oil reserves because of volatility in oil prices. So we've created here in the U.S. a strategic petroleum reserve that stores hundreds of millions of barrels of oil, or 60 days supply, roughly. But it hasn't been used to stabilize prices. It's been used as a reserve in case of war or some serious event. In 2000, Clinton established a heating oil reserve, originally in New York and New Haven, right here, storing heating oil. And today the heating oil reserve is in Groton, Connecticut, and Revere, Massachusetts. The government has taken oil because they're worried about people not being able to heat their homes. This is a smaller reserve, and they have sold from it to try to stabilize prices. The Persian Gulf War, 1990-1991, was another major disruption, not as big as the first and second oil crisis. And then there was a second oil. It seems to be oil is driven primarily by politics, oil price fluctuations. The second Gulf War oil price spike came in 2003. And now, 2008, we've had, after the financial crisis, we've had extremely volatile oil prices. Prices of oil got to $113 a barrel at the height of the financial crisis. Again, it makes it look like it was caused by, maybe it was partly caused by, we've had financial and economic crises whenever oil price spiked. But this one wasn't caused by a war in the Middle East or anything like that. Then, after this peak price, it fell to under $30 a barrel by 2016. Part of the reason it fell is new technology. In response to this very high price per barrel, the new technology called fracking was developed to produce an increased supply of oil. There is a danger of market manipulation.
Right.
And we already have surveillance against market manipulators. The stock exchanges have their own surveillance departments. Yes, that's a possibility. That's not a speculator, that's a manipulator. Yeah, so there have been talk about during wartime, a country could take a position in the stock market of another country and then make some proclamation of war or something to move the market a lot, and then sell, and then change your say, no, we weren't really starting a war, we're just talking. But I don't know how many historical examples there are of that. I think market manipulation is a proven phenomenon, but it's not as big, I think, as people imagine, especially when we have market surveillance. So now the other thing is, I am not one to say that markets are efficient. I was just here praising speculation, but I'm not saying that they work perfectly. And I've written papers saying that there's excess volatility. And that's coming from speculators. So I think it's an in-between picture. We do have speculator-induced volatility, but we also have a price that makes some general sense. It would be much worse without the speculators. Now, there's another kind of futures contract, which is a financial futures, developed much later. And so one example of that is the S&P 500 stock price futures. And that's cash settled rather than physical delivery. And the settlement is, at the last day, is equal to $250 times the index on the last day minus the futures price the day before. So the fair value for this, it looks similar to the fair value for commodities. The fair value, which is what the price should be, is equal to the price, I could say, times 1 plus R minus Y, where Y is the dividend yield. But that's the same formula if you make Y equal to minus a negative storage cost. The storage cost for stocks is negative because they pay a dividend, and if you're storing stocks, you get the dividend. So it's the same fair value formula, except that we minus Y equals S. The federal funds futures market is another example of a financial futures market, but it's a market on the federal funds rate, which is the interest rate charged by banks on loans to each other. And it's also the overnight interest rate that the Fed targets in its monetary policy. It was created by the Chicago Board of Trade in 1988. And of course it's cash settled. You can't physically deliver the federal funds rate. The settlement price is 100 minus the annualized federal funds rate averaged over the contract month. It's used widely to show expectations of actions of the Federal Open Market Committee. So I don't have a fair value for the federal funds futures market because it's not storable. But it's an overnight contract, you're just predicting. But it's often used to tell you what the expectations are for interest rates in the future. So you understand that the price represents 100 minus the annualized federal funds rate.
I'm interested in the federal funds rate futures market. How accurate is it in predicting the Fed's behavior, and what economic value does it add?
Well, the federal funds rate is the policy tool of or target of the Federal Reserve System. They announce targets for the federal funds rate in their regular statements of the Federal Open Market Committee. So the federal funds futures market is watched a lot. Often the people are paying attention to the near-term market. So they're trying to predict the federal funds rate just months into the future. There's a lot of thought that goes into this. So this is a futures market that I think would be filled with a lot of intelligent speculators who want to really hit the target. And as such, I think it is a successful market, that the price reflecting expectations of future federal funds rate is widely accepted as a barometer of the likely outcome of the next FOMC meeting. I think it's a good indicator, and I think there's a reason for that. The kinds of things that are where speculation is poorer is in markets like the stock market. What does the stock price predict? Well, theoretically, ideally, it predicts some kind of present value of future dividends or earnings. But how long into the future is that? A long time into the future, because the stock market isn't going away, right? When you own a company, you own it for eternity, as long as that company lives. So it's a prediction not of something that's coming right up and is being talked about concretely. It's a prediction about something in the indefinite future. So that market doesn't seem to work as well as a prediction market as the federal funds futures market. So I think markets work really well. Market efficiency works really well when it's a short-term, clear outcome prediction that is talked about and that is studied. When you look at the federal funds futures market, people who trade in that, they seem to be focused on what is that number going to be. When you look at the stock market, it's much more nebulous and less perfect. An option is a contract. There's both two sides to any contract. There's the buyer of the option and writer of the option. So there are two kinds of options. I've already alluded to that. A call option is a right to buy. A put option is a right to sell at your discretion. With a call option, you are buying the right to buy something, which is specified in the contract, at a predetermined price. That means you don't have to wait to find out what the market price is of that item on the day of purchase. It's locked in advance. But we call it an option because you don't have to purchase it. You can wait and see. It's different from a forward contract to buy something, because in a forward contract, you are not only having the option to buy, you are committed to buy. You signed a contract, a forward contract, to buy something in the future. It means I promise to buy it. Both sides are bound. The buying side of a forward contract is bound to buy. The selling side is bound, promised, to sell at that price. But options give a choice to the buyer of the option. And at the time that the option is bought, the buyer of the option compensates the seller of the, they call it the writer of the option, because the writer of the option is now subject to the choice in the future of the buyer of the option, and it has to be compensated for giving that choice to the other person. So what is the essence of options? Some people think it has something to do with free will. That is, that you can do whatever you want, and maybe you will be happier in the future if you buy it, or maybe you won't. You can wait and see. But actually, in finance, it doesn't have much to do with free will or feelings generally. You will generally buy the option if it pays to do that in finance. Most people will. So you will, if it's a call option, it's an option to buy something. You will buy it on the date specified if the price of the option is, if the price of buying it through the option is less than the price of buying it in the open market. Because you will always do that, even if you decide you don't want the object, because you can then sell it in the open market and make a profit. So options are truncated claims on asset. If it's a call option, it means that it's a claim on the price only if it rises above the contract option price. So that's a general idea. And so let me get a little bit more precise. The contract of the option have these terms: an exercise date or strike date. That's the date when the option expires, and you either have to buy if it's a call or sell if it's a put. And if you don't, then the option becomes worthless. And forever after, it's worthless. It's expired. It also specifies as the exercise price or strike price, which is the price at which you are, in the call option case, have the right to buy, and in the put option case, where you have the right to sell. The contract also has to specify what is the underlying, what is the object that has to be bought or sold, and how many of that, if it's shares. Now, options are not just for stocks. For example, suppose you are a builder and you're building a shopping center. You want to build a shopping center in the city, near a city. So you look around and you find, well, there's some farmland here that looks well positioned. Maybe I want to build my shopping center on this guy's farm. But he's a farmer, right? He doesn't know you're coming. So you walk over to him and you say, I'd like to buy an option on your farm. We haven't really finalized this deal to build a shopping center, but maybe we'll change our mind. But we want to know that we can get your farm. And the farmer might first say, no way, why do you want my farm? And then you say, look, it's just an option. If it expires unused, you just keep the money. So maybe the farmer will do that. He'll think about it and say, well, this guy's offering me money right now. Maybe nothing will come of it. So that's an example of an option. And it undoubtedly has a long history. There must have been many times going back to Sumerian times, if you listen to Will Getzman, when people thought of that. I'm thinking of buying something, but I don't know that the seller is willing to sell. So you would buy an option. So this is from one of Will Getzman's books, not the one I assigned for you. It was one that he wrote with Geert Rowenhorst. But it was a collection of essays, and these two Dutchmen, Gelderblum and Jonker, well, 3 of the 4 are Dutch. You can tell these Dutch names. Writing about the history of options. Well, the first options that are well documented come from Holland in maybe the 1600s, but this is an example from the year 1730. And unfortunately, it's in Dutch. I don't know if any of you can read that, but this is an example of an option to buy shares in, I can't pronounce this right, this like the General Royal India Company, which is a Dutch company in 1730. And so this is the options contract. Now the other thing that's kind of neat, the Dutch were the most advanced financially people in the world in the 1600s and maybe into the 1700s. This is a printed form. You see it's nicely done. This is printed. And someone has filled in the blanks in handwriting to make it an option contract. That was an important, this might be the beginning of the information age. Printed forms was a way of sort of putting in a program, right? A standard program. Some people call it boilerplate, referring to the plates that they made the printing from. So it says, I, the undersigned, and it's later, options became much more common, and they were in newspapers. This is a clipping that I took 20 years ago or so from probably the Wall Street Journal, which used to carry options prices in the printed edition. So that's old, but I took this off of the web yesterday. The CBOE, Chicago Board Options Exchange, has a website. And this is, I just picked a company at random. This is Intel Corporation. It's a manufacturer of computer chips. This is the price of the share, last quote, I guess that's closing price, probably for last Friday, was $31.63 per share. Notice it's about $30. That's because companies do splits whenever it gets much farther than that, because this is very American. This looks right for the price of a share. And they'll keep splitting it if it keeps going up, so it stays around there. And it's paying a dividend per share of 26 cents quarterly. That's the underlying stock. Now, it shows, like in the newspaper column, it shows the exercise prices. Now, I think they're trying to be confusing here. INTC, for Intel Corporation, is the ticker for Intel. What is the ticker? It's an abbreviation for the company name, which is used in financial reporting. It's a 4-letter ticker, which is a clue that it's NASDAQ listed rather than New York Stock Exchange, which normally stop at 3 letters. And so it gives the, well, here is the strike prices. $27 a share, $30 a share, $32 a share, and $35 a share. And now the price per share is 31. This is a right to buy it for more than it's selling for today. So it's out of the money. So I wouldn't want, why would anyone want this option if it's a right to buy the share for more than it costs to buy it? Well, I'll tell you why someone would buy this option. Because it might go up. The price might go up. And you'd say, well, if you think it might go up, why don't you just buy the share? Well, but if I buy the share, I'm incurring a risk that it might go down. I could lose, I had to pay $31 to get a share. I could lose the whole thing if there was some really bad news. But here I only have, when I buy the option, I'm only paying $2.36. So I'm not risking as much. So I'll do it. I mean, this looks like a reasonable price. Well, it probably is a reasonable price because it's the market price for the option. So you'd be willing to pay $2.36 for the thought that you will, if the price of a share goes up above $35, that's not too far from where it is now, then I'll be able to buy it for only $35. So that's worth something. This one is in the money because I could buy it today for $7. Well, if I forget the price of buying it, I could buy it today and then exercise it at $27, and then it would be immediately worth $31. That's a difference of $4.63. So would it be smart to buy this option today and exercise it immediately? No, because you'd lose money because you paid more for the option than you'd make as profit. You'd make the difference between $27 and $31.63, which is $4.63. But I just paid $7 for that right, so I wouldn't exercise it immediately. Generally, you don't want to exercise options early because they have option value. The option value is the risk, is the value that you get the upside without so much downside. So you generally want to wait to exercise an option. That means demand that you buy the stock in the case of a call at the exercise price. But now they also have two other prices, bid and asked. That's because this is an actual last price that a trade was made, but things have changed since then. I was doing this on a Sunday, by the way. There are dealers, market makers, who are quoting prices that you can buy and sell at. So the bid price is what if you want to sell your option back, you can buy, the dealer is offering $6.05 for the $27 strike price option. But if you want to buy the option, the market maker is offering $6.20. There's a difference. That's called the bid-ask spread. So the dealer is asking 15 cents more per option than the dealer is willing to pay. That's how the dealer makes money. This strike price 35 seems to be the most active. So it has the most narrow bid-ask spread. It's the most competitive market. So I want to go right to the question, why do we have options? Why do they matter? There's both a theoretical approach to that and there's a behavioral approach to that. The theoretical reason goes back to Kenneth Arrow, who is a highly esteemed mathematical economist, who talked about economic efficiency, meaning efficiency in our economic system, requiring that all risks are traded. And the risk that a stock will go up above the strike price or will go above another strike price are all risks that might matter to some person who needs help, who has risks that somehow focus on that risk and would like to trade the risk in order to reduce the risk or maybe to do some kind of business. So Arrow gave the sense that a major source of economic inefficiency is cured by options market. And Stephen Ross, who used to be here at Yale, is still living here in New Haven, has a famous paper in 1976 called Options and Efficiency, arguing that options, if you have a complete set of options, you've, in a sense, completed the market. You've dissected the risk into all the different strike prices and exercise dates into many risks. Each stock is really many risks, not just one, and they matter differentially to different people. That's the pure theory justification of options, and there's much truth in that. But I want to add to that also a behavioral approach to options pricing. Behavioral finance looks at how people really think, or how sometimes they don't act logically. One thing we pointed out already about behavioral finance is that people pay attention to salient things. That's a psycho, maybe it's a psych term saying something that grabs your attention. And so it seems like people overreact to the news. For example, after a flood, lots of people buy flood insurance for their homes. Why didn't they buy it before that? They should have known, right, that there's a possibility of a flood. But they don't. People are human, right, and they forget. So they all of a sudden want flood insurance. A put option is like insurance on a stock. Suppose you're owning a stock and you think, I have big hopes for this stock, but suddenly something scares me and I think that the stock price might fall. So I would then buy a put option on the shares I own with an out-of-the-money strike price, way below the current price of the stock, and that puts a floor on my investment, because if the stock falls below that, I can always exercise the option and sell it at this option price. Hirsch Sheffrin and Meyer Statman are two behavioral finance people who describe what they call a silver lining theory, a theory that people in their emotions don't look only at the bottom line. They look at different aspects of their portfolio. Suppose the stock market has gone way down and you've lost a lot of money and you're feeling bad. Why did I put all this money in the stock market? But then you look that you also put a put on some of your shares, and then you feel better. You feel, I'm kicking myself for having put so much in the stock market, but at least I had the good sense to buy some puts on some of my shares so that I had the right to sell them, and I didn't lose so much money. And so you just feel better. The theory here is that people don't focus appropriately, as financial theory says, on their total portfolio. They look at little details and they think, well, I lost a lot of money, but there's a silver lining I put on my actions. I put some of it into puts, and boy, am I glad I did that. So if people think that way, that opens up the the possibility for salespeople to kind of manipulate you and deceive you into buying options. So Sheffrin and Statman, in their famous paper on silver lining, quote a investment. This is a book. I'm quoting. I'm taking their quote from it. A book by Mr. Gross, who writes about how to be a stockbroker. So the title of his book is "The Art of Selling Intangibles: How to Make Your Millions by Investing Other People's Money." Now you can tell from this title of the book that Mr. Gross is not highly committed to serving his clients well. In fact, it's quite the opposite. Mr. Gross is telling you how to make a lot of money off of ignorant people. And what we like about this book is that Mr. Gross really comes out and says it. In fact, he gives you scripts for what to do on the phone with your clients. So you're now, suppose you're a stockbroker and you deal in stocks and options, and you've recommended some stocks to somebody and they have done badly. So you are Joe Salesman. You have told me that you have not been, now he's on the phone with John Prospect. Maybe he's a prospect for him to sell an option to. You've told me you've not been too pleased with your stock market investments. And John Prospect says, that's right. I'm dissatisfied with the return. So now Joe Salesman swings into action, trying to give him a point of view that makes him vulnerable to a sale of an option. starting tomorrow, how would you like to have 3 sources of profit every time you buy a common stock? Now this is really fishing, as Akerlof and I call it. You're supposed to be focused on the bottom line, not on 3 separate sources. But he wants you to think of it that way, so you'll feel better about yourself having done it this way. So predictably, Mr. Prospect responds, 3 sources of profit, what are they? And the sale. Now what he's trying to get this guy to do, who has bought a stock that's gone down and maybe he's worried about it, but he's hoping it will still go up. So he's saying, why don't you write a call on your option? I'll arrange it. You'll write a call and sell with an out-of-the-money strike price. That means at a price higher than the stock is right now. So the salesman explains, first you could collect a lot of dollars, maybe hundreds, sometimes thousands, for simply agreeing to sell your just bought stock at a higher price than you paid. And that's your money to keep forever. Your second source of profit would be the dividends due as the owner of the stock. You'll still collect dividends on the stock. They go directly. You're the owner. You still get them. The third source of profit would be the increase in the price from what you paid to the agreed selling price. All you're giving up is the possibility that the price goes up even more than what the strike price. And then he says, don't think about that. It says it's a what is the you are only giving up the unknowable profit possibility above the agreed price. These words are all carefully chosen to deceive you. So he's right, there are 3 sources of profit, but you as a logical, rational, economic human being should be asking, well, I don't care about the 3 separate sources. I want to add them up and look if it's a profit. But he doesn't add, in fact, he doesn't even quote any numbers. Well, except 3. He tells you there's 3 sources of profit. He doesn't tell you how big they are. So all you're doing is giving up this unknowable profit possibility beyond the strike price, as if that's nothing. But that could be a lot. And so this argument to sell a call option makes no sense. It can only make sense if he puts numbers on those 3 sources of profit, and then you add them up. You're supposed to do that. But apparently, not a lot of people don't think that way. So that's another reason why we have options. Well, options are everywhere. It's not just in stock options. I mentioned farm options. But there's option value in other things as well. Mortgages involve an option to default. Now, in the United States, we have 50 states in the United States of America, and each has its own mortgage regulator. And some states are called recourse states, and some are called non-recourse states. So here in Connecticut, we live in a recourse state. What that means is if you buy a house and take out a mortgage to borrow to get the house, and then you stop paying, the mortgage lender can go after you. They can garnish your paycheck. They can do legal proceedings to make you pay. In a non-recourse state, such as California, when you fail to pay on your mortgage, you default on your mortgage, the lender has only the right to evict you from the house and take the house, but cannot go after you further. In a non-recourse state, a mortgage is really an option of sorts. You can always just walk away from the mortgage. In fact, you can do something that's called jingle mail. You take the keys to your house, you put them in an envelope, and you mail it to the mortgage lender, and you say, I'm out of here, take the house. But that's not a right in Connecticut. Options are very old, as I said, but exchanges for options are not so old. In fact, we didn't have an options exchange until 1973, when the Chicago Board Options Exchange separated itself from the Chicago Board of Trade and started the first options exchange. And then they had standardized options. When I showed you that Dutch option from 1730, something was standardized, the form was standardized, but it didn't have a standardized strike price or exercise date because those were to be filled in. The problem with those Dutch options in 1730 is that you didn't even know what the market price was. There wasn't, they didn't even have telephone on how they could figure out a price. The broker would be trying to get you a good price by word of mouth somewhere. He'd walk into the stock market and talk to people there. But now we have options exchanges. And now they're traded on stock exchanges as well, and futures exchanges.
So Professor Shiller, actually on the topic of options for average investors, there's a lot of different financial instruments on the market, like ETFs, for example. A lot of them incorporate options and other derivative contracts into their portfolios. And so are these kind of investments potentially dangerous on the market for retail investors who may not know they're investing in a derivative instrument when they're buying an ETF or something else?
Yes, there are concerns. The derivatives have been called weapons of mass destruction. And because they might be subject to crashes in a crisis. That's what happened in the 2008 subprime crisis, that people had bought swaps or engaged in swaps that later the counterparty was about to go bankrupt. And so maybe the swap didn't work. And it led into a whole quagmire of problems of interdependencies. So the Dodd-Frank Act created in Washington the Office of Financial Research to try to look at the macro instability. Other countries have similar acts. There's a lot more attention now. The Financial Stability Board in Switzerland is paying attention to these issues and talking about how we can make the system more stable. The problem with derivatives is that they increased so rapidly that the data collection about them fell behind, and regulators weren't up to date on all of the issues. But on the other hand, derivatives have a useful purpose, just as insurance has a useful purpose. So, when you insure your house against fire, that's a good thing to do. But you could buy a put, and now you can buy a put on, not your house, but on your real estate community now at the Chicago Mercantile Exchange. And these kinds of things are developing, and it may lead us into a better society. And the way to put a bottom line on it is they lower inequality. People think inequality is something that only the government can deal with, but actually the biggest arsenal against economic inequality is not the government, it's the insurance industry that helps people from being hit by health problems or fires on their house and other things that make for painful inequality. So this shows an option on the day of expiration. The value of the option, as we call it, the intrinsic value of this is a call option, and against the stock price. So if it's a call option, and now it's the last day, you either exercise now or forget it. If the stock is worth less than $20, the option is worthless. You tear it up and throw it away. You would not pay $20 today. If the stock price were $15, you would not pay $20 to get something worth $15. But if it's in the money on the last day, on the exercise day, the option is worth the difference between the stock price and the option price. So if the stock price is $25, then you would definitely exercise because you pay $20 to exercise it, and you can sell the stock immediately. So it's $5. It's like money in the bank, money lying on the street. Almost everybody does that. The only people who don't exercise in the money options on the exercise date are people who are not paying attention. And I think that's actually rare. Not many people make that mistake. So the value of the option on the last day has to follow this curve. If the stock price is less than the exercise price, here 20, the option is worthless. But if it's above it, it's equal to the stock price minus the exercise price. For put options, it's different. This is the right to sell, so you will only exercise it if the option price is below the stock price. Now there's something called the put-call parity relation, which is a relationship enforced by arbitrage between a put price and a stock price that have the same underlying, the same strike price, and the same exercise date. And that says that these two things are equivalent. The first two lines are equivalent. I just put the items in a different order. So the price of the stock has to equal the call price plus the present discounted value of the strike. Now this is any date up to, and this is technically for European options, but it applies generally to both European and American options. The price of the stock equals the call price plus the present discounted value of the strike price plus the present discounted value of dividends coming in between now and the exercise date minus the put price. It does hold up pretty well. So Intel Corp, I showed you the example from the CBOE. And so where was it? Back here. I'm using the first line here, strike price of 27. Now this was the last price for the option, but currently the market maker has a bid-ask spread between 605 and 620. So I'll take the midpoint of the bid-ask spread as an indicator of the current market price. And similarly, the same strike price is available for the same date. It's expiring on January 19th of 2018. They're both expiring on the same day. And so I'll take the midpoint of bid and ask for the put. And then I'll go back to that slide here. Okay. This is the midpoint of the call prices, the sum of the two values divided by 2, plus the strike price. Oh, I'm assuming a zero interest rate to do this quickly in our head. So I'm not taking present values. Well, interest rates are pretty low now, so I'm being rough when I say that. Now I have to figure out how many dividends are between now and January 19th, 2018. And I didn't carefully figure, I thought there's about 8 of them. So 26 cents times 8 is $2.08. And then this is the midpoint of the bid and ask spread for the puts. And I add them all up and I get $32.54. That's pretty close to the stock price of $31.63. Why isn't it exactly the same? Well, first of all, most notably, I didn't even do the interest rate calculations. So the interest rates are not exactly zero. So that would bring down the present value of the strike price and the present value of the dividends. But also there's just some non-synchrony here. I'm looking at a last price, comparing that with a dealer's bid and ask. There's a little timing looseness here, so it doesn't work out exactly. But generally, it has to work out that the so-called put-call parity relation has to hold, because it's the same thing. You're pricing apples and oranges, but it's really apples and apples. Think of it this way. The yellow line is the intrinsic value of a call. The pink line is the intrinsic value of a put. If you add the present value of the strike price to this sum of the puts and calls line, you get the stock price again. And dividends as well have to be brought in. So put-call parity is a fundamental relation that actually holds quite well if you do it exactly right in the options market. And what it really means is that, in effect, you don't even need both puts and calls. It's just for convenience, because they're related to each other through the put-call parity relation. Now, what is the price of an option on a day before the last day? On the last day, it gets all simple. The price of the option is the intrinsic value because there's no more risk. It's now. Well, there's only negligible risk over a matter of minutes that it would take you to sell. So this is the intrinsic value, which is the value on the last day. On an earlier day, now we're talking about months or years before the exercise date, the stock option is, or whatever option, it's got to be worth more than the intrinsic value because it has option value. So consider here, suppose this is we're looking at a call option now with a strike price of 20. It says that there's value when the stock price is 15, there's value to the option. Why would it be worth anything if it's out of the money? Well, this is obvious, because it might go up. So I'm willing to pay something for the option. Suppose the stock price goes up to 25, then my option price is going to be worth a lot on the exercise date. So the option has to be worth something even though it's out of the money. They're never worthless. It might be very minuscule, but there's always a chance that the stock will go up above the exercise price, so it has to be worth something. Well, then you also, well, why is it worth more than the underlying value when it's above the exercise price? Well, it's for the same reason that if the stock price were to fall below the exercise price, you'd lose the full amount if you owned the stock. But when you own the option, you've still got something. You've got the option value. The option isn't worthless if it has some time to expire, even though its intrinsic value is worthless. You understand what no arbitrage means? No arbitrage means no sure profits. Any profit that you make has to entail risk. There's no $10 of, you see any $10 bills lying on the floor? No, you don't. Why not? Somebody would have picked it up. Somebody at some point must have lost a $10 bill in this room, but it's not there anymore. Those things are rare that you'll ever find one because the first person to see it picks it up. So similarly, we don't expect to see the put-call parity relation violated. If that were violated, I can tell you, here's a good job for you. Drop out of college and invest in disparities between put-call parity. And you make money for sure. So you might as well just push it to the limit and borrow millions of dollars and just do it on a big scale. So it's so simple and obvious once you look at it. You can be sure that there are guys out there right now arbitrage, making profits from the tiny discrepancies in put-call parity. But they eliminate the discrepancy when they do that. What options you might say are really for is managing risks. So that, for example, someone who owns a stock, suppose you are looking at a company and you think it's very promising, so you wanted to invest in it. So you want to hold shares of a company. But you also have worries that the price could fall and you would be left with nothing. Could fall a lot. So you could buy a put option on the shares that you own. This is very common, and therefore put a floor on your losses. You can't fall below the put option. If the stock price falls below the put option price, the strike price on the put option, you just exercise the option and you're out. It cancels out your losses on the stock. But here's a basic question that I want to just kind of conclude mostly with this thought, and that is, there's another way to insure yourself against losses on the stocks you own. It's something called a stop-loss order. Here's what you do. You call your broker and you say, I have 1,000 shares of Intel stock and they're worth $31.63 today. You know, I'm worried. I just can't sleep at night. I need some help. So instead of recommending a psychiatrist or a sleep aid, your broker says, well, why don't you just put a stop-loss order? Just leave it with me. I'm your broker. I have it under instruction for you that if the price ever falls below, what do you name? Give me any price. Then you say $20 a share. Okay, I'm ready. I'll sell the stock whenever it falls below $20 a share. So then you can sleep easy at night. You put in a stop-loss order. So what's the difference between doing that and buying a put? This often puzzles people. Well, you might say it's better to put a stop-loss order in because that doesn't cost anything. Well, it's just the transaction fee. But there's no option price. You don't have to pay for an option that might end up worthless if the stock doesn't fall below the strike price. So why would you do that? Well, I think this gets into some technical details. And I'll tell you what it is. Suppose you told your broker to sell your shares of Intel when they fall below $20. Now, this broker is operating as a real human being in real time and has to make some, well, he probably would just fill your order. But what will happen? The stock will be fluctuating, and it's gotten close to $20, and it dips down to $19. The broker says, uh-oh, I better sell right now. I said I'd sell at 20. As soon as, but it probably, you're not going to get 20 exactly. If you have a stop loss order, it merely says the broker starts trying to sell it at 20. So you'll probably get less than 20. So it didn't protect you fully. So suppose the stock falls to 19 and he sells your stock. And then it jumps up again to 21. Then what do? Well, you can tell your broker, I guess it's not below the threshold I said anymore, so buy it back. So the broker says, okay, I'll buy it back. And then suppose the next day it falls to 19 again. You're faced with the same decision again. What do you tell your broker? Well, buy it back. So we've just gone through 2 days where you both lost $2 on a trade because you sold low and you bought high twice in a row. So that's why you buy a put instead of a stop loss order. I'm not saying one is right and one is wrong, but I'm just saying that ideally you have to compare the option price with the losses you might make, as I've just described, in dealing with stop loss order.
Do you think like options prices have a predictive power on the stock prices? Like, for example, can we sort of foresee a stock market crash by looking at the put option prices?
There's something else that the Chicago Board Options Exchange computes, and it's called SKEW, S-K-E-W, CBOE SKEW. It's computed also from options prices, but instead of looking at the second moment, the variance or squared standard deviation, they look at the third moment, implied by options prices. When put options, out-of-the-money puts, are getting expensive, that suggests that the market is worried about a crash. And the prices of those puts will go up. And then there's a tendency, ever since the 1987 crash, there's been a tendency for out-of-the-money puts to be expensive. If you want to protect yourself against the market crash, it's expensive. So now what you're asking is, does a high skew index predict the next crash? My thought on that, first of all, there's some literature. There's so much finance literature. I don't know, I don't recall all of the information about it. I seem to remember a paper about the skew, CBOE skew index, predicting volatility. But you're right, it sounds like it should be predicting a crash. I'm also thinking of a plot of skew. And since the skew only goes back to 1990, that the CBOE has published. And there were a couple of periods of high skew. One of them was I think around the Russian debt crisis in 1998. And the market did take a tumble, but I'd have to get it. Remember, skew is a 30-day ahead thing. You have to be careful whether the 30 days when the market tumbled fell into the 30 days that it was forecasting. My guess is that skew might be helpful in predicting stock market declines of a short-term nature, but not necessarily in forecasting the big events that you care about. The really big stock market crashes didn't happen in 30 days. For example, the 1929 stock market crash is remembered everywhere. And people remember it as October 28th, 1929, the bottom fell out of the market. But what they forget is that the market came right back up on October 30th, 1929, and it kept bouncing around. The real decline took over almost 3 years. It was until 32 that it bottomed out. So you could have been investing in puts to protect yourself against the 1929 crash. And I don't know, I'd have to go back and do complicated calculations to figure out what doing a sequence of 30-day puts would have done. I suspect it might not have protected you. It's a complicated business. Once again, talk to your financial advisor and make sure you have a good advisor.